Ever wondered how high net worth Australians retire with millions? How they leverage the system to snowball their wealth into a seriously lucrative retirement? Well, it's not just about saving anymore, it's about making smarter decisions. In this video, I'm going to reveal the strategies that Australia's wealthy use to build their retirement fortunes and how you can apply these same techniques to secure your own financial future and retirement. One of the first things that high net worth investors think about differently and do differently is that they worry more about outcomes than they worry about costs. That is, they understand and value the benefit of working with a professional. They're willing to pay the best lawyers to review a contract. They're willing to pay the best CIOs or financial advisors to help them manage their money. And obviously there's some level of conflict being a financial advisor, but the key here is that they accept that other people have greater experiences and competitive advantages in different areas that they don't, and which are much better off outsourcing to someone that has specialized as opposed to trying to teach yourself and become the best at something else. But they focus very much on outcomes, and it doesn't mean by any means that they are easy with money. That is, they pay fees for things that don't offer the value that they expect. I think the difference is that DIY investors tend to do the opposite. They think the lowest cost investment is always the best. They also believe that the SPIVA data, so the active versus passive discussion that we have all the time, applies to everyone. High net worth investors will use both passive and active, but they are willing to pay for active management and pay well for them, but only, and the key here is only, if they are able to deliver outcomes in the terms of providing something different or outperforming a benchmark. And I think that's one thing we forget about. That we're constantly talking about outperforming a benchmark when we have an active management, but what we're really paying for is someone to do something different as opposed to just getting the average market return, which high net worth investors, in my experience, are expecting better than, or at least a smoother ride than everyone else. They also pay for differentiation and a competitive advantage. Consider, for instance, that a normal private equity fund will charge you 2% as a management fee every year and 20% of the outperformance over a set benchmark each year. If I sent this to a DIY investor, they would freak out about the fees. But if your after-tax return is like 15 or 20% after those fees, do you really care what the fees were? As long as the outcome is good and the process and the quality is what you look for, then I think outcomes need to be weighed above costs, while not just throwing away money and paying more for things that we don't need to. I think a key here is that performance fees are more popular and comfortable for a high net worth investor to accept as opposed to a normal DIY investor. The second thing I want to talk about is that they aren't afraid of risk, rather they embrace it. So often you hear the comment that says the return is high, it must be risky. And it's important, while it's important to be critical on investments, we need to remember it isn't a bad thing to be taking risk. High net worth investors understand this better than most. A lot of this has come from running a business themselves or being part of a partnership or being part of something bigger. Risk or volatility is the cost of admission when you're investing. That is, if you're not able to understand that the value of your assets will go up and down every day, then you shouldn't be investing in share markets or crypto or any other sector for that matter. You just need to know how much and what you're risking. Common example is I see some people think that holding a standard ETF is incredibly low risk when it's actually the opposite. You're actually exposed to more risk than someone that potentially is in an active fund that has very different allocations to sectors, say the banking sector and the resource sector. The link here is that a longer term mindset allows high net worth investors to have a higher exposure to riskier assets and to be more patient with them. And by a longer term mindset, being high net worth, these people tend to have enough assets that they'll be able to pass on to their children. They can, rather than just worry about their retirement of 30 years, they can start thinking 30, 40, 50 years or even more ahead, 100 years ahead. And when you start thinking about investment from that perspective, you can take a very different view on what happens on a daily basis. And this embrace of risk is why the more popular investments with high net worth investors are investing in private markets like private equity, in unlisted property or direct credit or direct lending where you're making loans to individual businesses. The third thing I think that is a differentiation, this leads on from the second, is that they think in decades, not in days. And we all do this every now and then. We think about the issues that are present today as opposed to looking into the future. There are enough reasons to sell any company. You could go through BHP, you could go through Xero, you could go through Soul Patts. There's enough reasons if you look close enough to sell any business or any investment on any given day and move it all back to cash. But doing so locks you into the doldrums. If you lengthen your time horizon, which is several decades for most retirees and for high net worth investors, your mindset can shift. We can allow businesses to evolve. We can allow our investments to compound. We now have to worry less about daily volatility and see it as an opportunity, not a concern. High net worth investors think about what they're leaving to their children and investing for them as opposed to worrying what's happening on a daily basis. This is also shared by many self-funded retirees and can be. Therefore, you have the ability to balance growth and income more evenly if you're thinking further and further in the future, as long as, of course, you have enough liquid cash to fund your lifestyle and expenses at the current time. And this is something they also do differently, which is have a pool of liquid assets which allows them to take more risk and benefit from the premium that comes with accepting some form of illiquidity. Which leads me on to my next note, which is high net worth investors accept illiquidity. Now, illiquidity, if you mention this in most public forums, it sends people running for the hills. It simply means you can't get all your money or a certain amount of your money out in investment as quickly as you want to. For instance, share markets, incredibly liquid. You sell your shares, you get the money within 2 days, and you can do whatever you want with it. Private equity, in some instances, you need to invest for 7 to 10 years before you get your money back. An unlisted property, buying a residential property, you may not be able to sell it at auction, but it is somewhat more liquid than a long-term private market fund. I think the key here is that liquidity comes with daily price changes or volatility. And while this might make sense for a portion of your portfolio, you don't want to see this every day. It's not going to help you make good financial decisions. It's not conducive to dealing with periods of stress and volatility. So what accepting a higher level of liquidity does, it allows you to hold longer term assets that are proven to deliver better returns than listed markets. This offers the ability not only to smooth the ride, but actually diversify further. Something like 98% of companies in the world with reasonable levels of revenue, over 2 million, are unlisted. That means you can't invest in them on the share market, which means if you're just investing into listed shares, you're missing out on a massive part of the global economy and the potential growth, returns, income, and diversification that comes with that. Illiquid investments, valued less frequently, therefore smooth the ride and see your value go up and down less, which helps them make better decisions. And you can also, as a high net worth investor, get more involved with the management and future of that business if that's something of interest to you. And I think one of the keys here is they offer resilience. This is a smoother ride in retirement, and it has proven through the likes of the Future Fund and large sovereign wealth funds around the world that they can deliver higher returns and can do so consistently. But you need to balance illiquidity with having a liquid portion of your portfolio as well. The second last one I want to talk about is that high net worth investors don't DIY. They don't do it themselves. Yes, they have business experience and they may run a business, but they don't see themselves as being the smartest person in the room when it comes to stock picking or picking a private equity manager or finding another 10 businesses to run. They don't run their own share portfolios. They don't try to find small cap bargains. They don't try to find the highest yielding stock on the ASX. They don't chase crypto. They accept and trust experts. Whether it's a lawyer to review a contract, an estate planner to do their will, not a news agent or post office will, and they trust an accountant to prepare and lodge their tax returns. Similarly, trust an advisor to build a portfolio or advise on superannuation. They look for support in areas where they cannot add value or it would be too time consuming and invaluable to try and add value. And the last one I'd want to talk about is they think about tax, but they don't rely on it. And a key here is that a lot of the biggest mistakes that come in investing come from solely tax-driven investments. So they think about tax from a high-level perspective, but they don't let their investment decisions be driven by tax. They make sure investments are held in the right entities. Do you hold something in your personal name? Do you hold something in a family trust, in a company? What are the tax rates? How do they relate to each other? How are capital gains going to be taxed if it's held in a family trust? Are there beneficiaries you can distribute that to? What are the things you're doing today that are going to impact the tax that's going to be payable in 5, 10, 15 years from now? Not just minimizing your tax return next year, but getting the most tax efficient outcome over a long period of time. And superannuation is obviously central to this. They think laterally and into the future, so not just the best outcome today, and they consider tax implications when trading. Well, do we need to sell something right now just because the share price has fallen, or is it better off delaying that capital gain for another financial year? Or are there other things we can do with those assets? Or do we even need to sell them at all if we think about it from an after tax or cost perspective? Key here, again, and you can apply this to yourself, is ensure any changes you make to your portfolio are material and they're not just adding to your costs. High net worth investors tend to look to control what they can and leave the rest to the experts. So once again, I hope this video has given you some tips on how high net worth investors are doing it and how you can apply some of those rules to your portfolio. And as always, I work with self-funded retirees and high net worth investors. If you're interested in learning more, please reach out, follow the page, send us an email, and ask any questions you might have.